Welcome back to my channel, ladies and gentlemen. Today's video I'm going to be sharing with you a secret strategy that I use to generate money on a daily basis trading the forex market. So this strategy that I'm about to share with you, I know most of you are familiar with it, but I'm going to give you some secret method that I use in trading this strategy. This is called the moving average strategy. So in this video, I'm going to share with you my secret moving average trading strategy with over 95% win rate. So my advice to you is to watch this video from the beginning till the end and make sure that you watch the video to the end because you are going to learn a lot from this video. So the moving average trading strategy has been adopted by many trading experts, and so many people are using it to generate substantial income from the forex market. So that is why I want to share this strategy with you guys so that you can go and practice it on your demo account. So there are different moving averages, but we are going to focus on the most important one. Moving average work only during a trending market and doesn't work during a ranging market. Like in my previous video where I taught you about market structure, so you know when to adopt a certain strategy in different market conditions. So this strategy that I'm about to share with you guys only works during a trending market, and you are not expected to use it during a ranging market. You get that? So now there are different types of moving averages. There are different types of moving averages, but the most important ones are the exponential moving average and the simple moving average. The simple moving average measures trend direction over a period of time, while the exponential moving average applies more weight to data in more current market condition. That is to say, the exponential moving average focuses on what is happening right now, while the simple moving average focuses on what has happened in the past, like 2 months ago, 1 month ago. But the exponential moving average is focusing on what is happening right now. It creates more weight in what is happening right now. It gives more data in what is happening right now. So that is why most traders prefer the exponential moving average rather than the simple moving average. So in this tutorial, what I'm going to use is the exponential moving average, and you are going to see how it works in the market and how you are going to implement it to gain more profit from the forex market. So ladies and gentlemen, before I continue further, my name is Austin Ikeru, and you all are welcome to my channel, Ostino FS. If you have not subscribed to the channel, please do that. Subscribe to the channel, turn on the notification icon to be the first to be notified whenever I upload new content. And also don't forget to give this video a thumbs up, share it on your social media handle, and come back for more. So let's get straight into the video. So we are going to make use of gold. Gold has been my favorite market because I love the volatility of gold. Gold has been my favorite market. That is why I always prefer trading gold. There are other markets that you can trade, like the Euro USD, the GBP USD, and so on and so forth. But for me specifically, I prefer trading the gold market because of the high volatility in the market. Like in a day, gold can give you 200 to 250 pips once you know how to trade the market. So that is why I always prefer trading the gold market. So in this tutorial, we are going to make use of the gold, and you can see the market is clean. You can see there is nothing there. The chart is clean. There is no indicator. There is nothing is there. So now to start trading the moving average strategy, remember that you also need to implement some price action strategy to this moving average strategy because they work together. So don't trade the moving average strategy alone. You need to include some price action trading strategy to blend it to make it have more confidence, to give you more confidence in your trading. So now, before we start, the first thing we have to do is to look at the market structure. That's the number one thing you need to do whenever you enter the market. You look at the market structure so that you know when to implement the right strategy. So when we look at the market structure clearly, if we look at the market structure clearly from here, we can clearly see that the market is in a downtrend. We can clearly see that the market is in a downtrend. So this tells us that the market is in a trend, and has given us the confirmation that we can go ahead with the moving average trading strategy. So now we have confirmed that the market is in a downtrend. So what we have to do is to plot in our moving average. We'll go to the indicator. Okay, I think I already have it here. We'll go to the indicator. This is the indicator, right? You click the indicator, and this is the moving average. But for the fact I have it already, what I'll do is to just make it visible, right? Make it visible, make it visible. So now what I have here is three moving averages. Three moving averages. Remember, this strategy works in all time frame. Whether you are trading the daily time frame, you are trading the 4-hour time frame, you are trading the 1-hour time frame, you are trading the 30-minute time frame, you are trading the 15-minute time frame, or you are trading the 5-minute time frame. This particular strategy works in all time frame. So it's not it doesn't say it works on this time frame and doesn't work on this time frame. It works on all time frame, right? So for this tutorial, we are going to make use of the 1-hour time frame. Remember that time frame has to do with your personality. If you're a day trader, I think the 15-minute time frame and the 1-hour time frame is what you should implement. But if you are a swing trader, you can go with the 4-hour time frame and the 1-hour time frame. But if you are a position trader, you can go with the daily time frame, the weekly time frame, and so on and so forth. So in this tutorial, we are going to make use of the 1-hour time frame. So you can see there 1-hour time frame. Now we have implemented our moving averages, that is the exponential moving average. So we have the first one here, the 200 moving average, which is the black color line. This is the 200 moving average. Then we have the second one, which is the 50 EMA, the 50 exponential moving average, which is this blue line. This blue line is the 50 exponential moving average. While we have the 20 EMA, which is this is it a purple color? Yeah, this color. I don't know whether it's purple. Yeah, this purple color, or I don't know, orange color. Let me use orange. This orange color. This is the 20 exponential moving average. So we are making use of these three moving average in this strategy. So now there are three things that you can do with these moving averages. There are three things that you can do with this moving average. The first one is this moving average will help you to know the direction of the trend. It will help you to know the direction of the trend. Whenever the price, the candlestick is below the three moving averages, this tells you that the market is in a strong downtrend. And whenever the price or the candlesticks are above the three moving averages, it tells you that the market is in a strong uptrend. Like if you can see now, the market is in a downtrend. Then you have to understand that there are different types of trend. We have the strong trend, we have the healthy trend, and we have the weak trend. So when you are in a strong trend, the moving average tends to respect the 20 EMA. This means that you are in a strong trend. Whenever the moving average is respecting the 20 EMA, it signifies that you are in a strong trend. But whenever the price is respecting the 50 EMA, it means you are in a healthy trend. Then whenever the price is respecting the 200 EMA, it means you are in a weak trend. So you have to understand this. It is very, very important. That is why we have to plot in the three moving averages, so that we will know the ones that the price is respecting, so that we will trade according to that one. Okay, look at it again. Now you can see that the price is above the three EMAs, which tells you that the market is going up. You can see the market is going up. Let me look for another example again. Look at it here. The price is going down because the prices are below the 3 moving averages. So these are things you should be looking out for in the market. Let's look at another time frame and see what is happening. That let's look at the 15-minute time frame for intraday traders. That is for day traders, right? All right. So like I said, the market this strategy only works during a trending market, and it doesn't work during a ranging market. Please take note of that. Like now, if you look here, this cycle, if you look at this place now, from here to here, you can see the market is ranging. There is no trend going on. So you can see that the moving average is not working in this market because the market is purely a ranging market. So look at it. You can see it crosses over, went to nowhere, comes down, goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down. So if you are trading the moving average in a ranging market, you are going to be crying because your stop loss will be hit so many times, and if you don't take time, you might blow off your account. So that is why I advise don't use the moving average during a ranging market. So make sure that you are implementing it when the market is trending. So look at an example of what I'm talking about here. This is a trending market. You can see that the 3 moving averages are above the price, the candlestick, which signifies that the market is in a downtrend. This is an example of what I'm talking about. So let's go back to our 1 hour time frame. All right. Now that we have understand the first way of trading the moving average, which it tells us the direction of the trend, the second way is the moving average crossover. Now this determines your entry and your exit. So as a moving average trading as a moving average trader, you should also consider the crossover. They are very important. When the faster EMA crosses over the slower EMA, it signifies that the market have changed trend. So another way to trade the moving average is using the crossover trading strategy. For now, you can see that the 20 EMA crosses over the 50 EMA and the market started going down. You can see the crossover here. The market started going down. That is an example. You wait for a crossover and make sure that the price closes below the moving average, because if the price does not close, that means that crossover has not been authenticated. So you have to wait for the moving average to cross and close before below or above the slower moving average. So let's assume that you want to make use of the 20 and the 50 EMA, right, as your the strategy that you want to use for this crossover strategy. So what you do is that you open the chart and then you wait for a crossover. You understand? You wait for a crossover. Let's assume that, let's just say you can close the 200 so that I don't be confused, right? So now we have only 2 charts, only 2 moving average on this chart, right? So now if you want to make use of the moving average crossover, what you have to do is to look at the market price action. Now whenever the 20 EMA crosses over the 50 EMA, it tells you that the market have changed direction. Like let's say the market was formerly in an uptrend here. From here it was going up, right? It was going up. Then suddenly the 20 EMA crosses over the 50 EMA. This tells you that the market has entered into a downtrend. So what you have to do is you either wait for a pullback before you place your trade, or you place your trade immediately after the crossover. But bear it in mind that if you want a tighter stop loss, you have to wait for a pullback so that you can get a better entry. Let's assume that this is the candle that makes the crossover. Here, this a long red candle is the one that make this crossover, right? If you are to place your sell trade here, you need to have a wide stop loss so that if the market makes maybe a retracement, it will not be able to get to your stop loss. Let's assume that you place your sell trade here. Then you have to make sure your stop loss above here, because once the price makes a retracement, it can break a little above this 50 EMA. But if your stop loss is very close, it might trigger it. Like look at this now, this is an example of it. It might trigger your stop loss. So if you are taking your sell trade immediately the crossover occurs, bear it in mind that the price can make a retracement before the downtrend continues. So you have to expand your stop loss above here. But if you want a tighter stop loss, you can exercise patience and wait for a pullback. So once the market crosses over the 50 EMA, when the 20 EMA crosses over the 50 EMA, you wait for a pullback, right? And this is the pullback. This is a pullback. Once the market comes back to the 20 to the 50 EMA, you simply put your set trade and put your stop loss above here, right? And then you can now ride the trend. Now remember that as a moving average trading trader, you are trading in the direction of the trend. Don't ever trade against the trend. So if you want to ride the trend, then you don't need to put a take profit. The way I do my own is this: I may place 3 trades, right? I place 3 trades and have a specific profit target for 2 and keep 1 for riding a trend. Now let's assume I'm the one that is trending this market right now, and I discover that the moving average has just crossed over. That is, the 20 EMA has crossed over the 50 EMA, and I wait for a pullback here. And once the pullback has occurred, I will place my set trade here and then put my stop loss above here. Then my 3 set trade will be here and my stop loss will be above here. Then my 2 set trade, I will target, like, maybe depending on the stop loss that I'm using, the pips that I'm using, I may use, like, let's assume 40 pips as my stop loss. Then I will target 80 pips as my take profit. Now let's assume that I target take profit here, right? Target my take profit here, the 80 pips here as my take profit. Then I will hold one. The third one, there's no target profit. I will just leave it like that, but I will make sure that I place stop loss in the 3 trades, but 1 there's no target profit. Then the remaining 2, I'll have like 80 pips or 100 pips take profit. So when the market comes and hit my take profit, the 2 trades will be out. Then the remaining 1, I will break even. So what I'll do, I'll take my stop loss to the entry, so that if in case the price comes back, it will just hit my stop loss and I will be out of the game without me losing anything. But I will still be in profit because I have 2 market that I have 2 trades that are already giving me profit, right? So if, let's say, luckily the market did not come back to my my stop loss, that means I'm going to ride this trend. You can see the trend is very massive. You can see it now. You can see it now. You can see it now. All the way from here. You can see, let's just say this is where I place my trade. This is where the crossover occurred. This is where I place my trade, right? This you can see the cursor. This is where I place my trade. Now I took my first take profit here, right? And the last one, I decided to say, okay, I want to ride the trend. I want to gain more money with this particular trade. So I will now bring my stop loss to break even, so that in case if the market goes back, it will just hit my stop loss and I'll be out of the game without me losing anything. But if the market favors me and the trend continue going down, that is a surplus for me. That is a plus for me. You can see that I will ride a very strong market. All these trend, I will ride all of them. Look at it. Look at the trend. Look at the trend. Look at the trend. It's still going down. Then my plan is to wait for another crossover. That is where I can take my trade. I'll wait for another crossover to take my trade, right? That is where I can take my trade, because as a trend follower, you always watch the crossover, because once a market crossover, it tends to reverse from that crossover and change direction. So you have to watch the crossover. So now that I'm riding the trend, I'm watching the crossover, right? I'm watching the crossover. So for me, I might be able to take my stop. I might be able to take my trade here. So you can see the market is in a downtrend, 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 downtrend. So now there's 2 crossover here. This is the first crossover and this is the second crossover. So I might take my trade. I might take out my trade at this crossover, right? Because I don't know what the market might do. The market might reverse and start heading up. So I might take my trade here, or I may wait for break of market structure. which means the market is no longer making a lower low and a lower high. Instead, the market breaks the previous high. That is, it means that the market has break the structure. So that is what I'll be looking at. If I am not looking at the crossover, I might be looking at the break of a market structure. But if I'm looking at the crossover, that means if the market crosses over here, I might be tempted to take my trade, because I don't want the market to move any further before I will start regretting. You understand? So I'll wait. If the market crosses over here, look at it, I might decide to take my trade here, because once it crosses over, it tends to make a pullback. So once the market crosses over here, right, and comes here to make a pullback, I might decide to take my trade here. Or if it crosses over and comes back here to make a pullback, I might decide to take my trade here, because I want to make sure that I secure my profit, because I might leave it and then it will reverse and then I'll be in the red. So I don't want that. I don't want my profit to turn to lose. You understand? So this is how we trade the crossover. So the last steps or last way to trade the moving average is you trade it as a dynamic support and resistance level. You can trade the EMA as a dynamic support and resistance level. Let me look for an example on this. You can see that the EMA is respecting the 20 EMA. Sorry, you can see that the price is respecting the 20 EMA. In this place now, the 20 EMA is acting as a dynamic support and resistance level. For the fact that the market is in an uptrend, the EMA line is acting as a dynamic support level. You can see that the market broke out of the EMA, comes here and tested the 50 EMA, then went up and they started testing the 20 EMA. Like I see, the market went up, came here and tested the 20 EMA. It went up again, came here and tested the 20 EMA. It went up again, came here, tested the 20 EMA, went up again. So you can see that the 20 EMA now is acting as a dynamic support level for this price action. You can see, let me look for another example again. Now this one is the 50 EMA is acting as a dynamic support too. The market breaks the 50 EMA, right, and then comes here and tested the 50 EMA, which makes the 50 EMA a dynamic resistance level, right, because this is a downtrend. The market now came to the 50 EMA, tested it and went down again, came back here again, couldn't break through it, went down again before it finally broke through it. So let me look for another example again. Look at another example again. The market broke the 50 EMA, came here, tested it, caused this long wick and couldn't break through it. It went down here, tested it again, came down, tested the 50 EMA again, came down here, tested it again, broke a little bit and then continued heading down. Come back to the 50 EMA again, couldn't break it and then continued heading down. You can see it. You can see it. Look at it again. It comes to the 50 EMA and went down. Came again, went down. So you can see the price action. So let's assume that you are trading using the 50 EMA as your dynamic support and resistance level. You have seen your entry. So whenever the price comes to the 50 EMA, you place your set trade. Whenever the price comes to the 50 EMA, you place your set trade, because you can see that the price is not able to break the 50 EMA. But bear it in mind, later on the price will eventually break the 50 EMA and the trend will change direction. Like you can see it here, the price finally broke the 50 EMA. You can see that the 20 EMA has crossed over the 50 EMA and the trend has changed direction. So as a trend follower, you have to understand the importance of these strategies. Make sure that you trade them in a trending market and don't ever adopt them in a ranging market. And also practice all this strategy in a demo account so that you can have confidence in them. You can trade them without having psychological problem or without having emotional problem. Don't allow your emotions to disrupt you. Make a clean trading environment and execute your trade without being scared of anything. So you can see that the moving average is one of the best strategy that many traders are using to generate money from the forex market. Like me, I specifically used this trading strategy, which is the moving average, to make much money. Like I told you, I use it for crossover, I use it for identifying the trend direction, and also use it as a dynamic support and resistance level. So I advise you to implement this strategy. First and foremost, backtest it, test it on your demo account, and make sure that you respect the money management rule. Like I said, always risk only 1% of your trading capital, and make sure that you always place a stop loss on your trade, because stop loss will help to protect your capital in case the market goes against you. So ladies and gentlemen, that is all I have for you on our today's training section. Don't forget to subscribe to my channel if you love this video, and also don't forget to turn on the notification icon to be the first to be notified whenever I upload new content. And also don't forget to share this video on your social media handle. Come back for more content, because I'm going to be updating you guys with the best strategy on how to profit from the forex market. Thank you once again, and I say may God bless you all. Enjoy the rest of your day. I will see you in my next update. Goodbye.